Hello, this is Wilfred Hahn, Co-Chief Investment Officer and Chairman of Hahn Investment Stewards. I'd like to bring you the monthly update for April. Today is May the 7th. Well, let's first turn, as we always do, to market events, market trends. Recently, at least for the last month, a very interesting month. Lots of volatility and varied movements among different asset classes and asset types. A couple of them that I'll mention, at least the key ones that have affected portfolios this month, have been the Canadian dollar, emerging markets, Canadian equities, I would say, versus the rest of the world. Of course, oil has rebounded fairly strongly here this last month, continuing somewhat of a longer rebound, and bonds have turned down this last month as well. So those are the major ones. I'll just mention some of the statistics here to give you a sense of how large some of these movements have been. The Canadian dollar, I had mentioned, was strong. Rising almost 4.5% against the US dollar just alone in the month of April. That's had a pretty big impact. Crude oil, so West Texas International Crude, rose 18.8% during the month, so quite a rebound, as mentioned earlier. Now, how did our portfolios do in that environment? Pretty well, considering. We have commented here a number of times, at least so far this year, at the remarkable market performances that we've seen. January was spectacularly strong. February was reasonably strong. We thought we'd see a little worse March. That was relatively strong. And finally here in April, we did get some negative reversals and some negative numbers across the portfolios. But the important thing always is to truncate the downs. The downs do always come. It's not always up months. And on that score, the portfolios didn't disappoint us. They all outperformed. And a couple of statistics here, just again to give you a scale of what will have happened in portfolios. The conservative core portfolios, all the three core portfolios outperformed their benchmarks. And we got declines as much as 1.6% for the conservative core portfolio, which will have had quite a bit of fixed income in it. And as I mentioned, bonds have had a downturn the last month after a very long up rally. However, the important thing always is to look longer term. 1 month does not make a long-term performance. And on that score, our portfolios are continuing to do very, very well. The 12-month numbers, so that's year over year, very strong. Again, for this set of three portfolios that I had mentioned that we're looking to here right now, performance is as much as 11% to as high as 15.5% or so. So a very, very good year. In this particular update, I always tend to talk about the core portfolios, but we have other ones as well. They are a little more aggressive. For example, our Special Opportunity Fund, that's up 19.2% year over year. What we're particularly happy about here most recently is that the portfolios have continued to do well, outperforming their benchmarks, despite the fact that we've continued to have a relatively high yield on all the portfolios. You may recall one of the big themes that we're continuing to pursue longer term is a response to the global income crisis that we still feel is unfolding. And that would mean that anything with a decent yield, income, dividend yield, what have you, is going to continue, will certainly be well bid over the long term. But in the short term, if you do get a sell-off in the bond market, that pretty much affects anything that's interest sensitive or interest generating. And so given that we've continued with that bias, it's quite nice to see that our portfolios continue to outperform. Year over year, the outperformances are quite gratifying. The conservative core portfolio has outperformed its benchmark by 33%, and the conservative core, the moderate core portfolio has outperformed its benchmark over the last year by 57%. Now, we like to believe that can be continued for a long time. That's not necessarily a reasonable expectation, but nonetheless, we're happy to see that our portfolios have done so well over the last year. I want to focus in on one theme, one particular factor, and That one being most relevant for Canadians, and that is I just want to show you here what the Canadian dollar has done. As mentioned earlier, the Canadian dollar rallied this last month fairly substantially against the US dollar, 4.5%. And if you can see the chart, you'll see that here in recent months, the Canadian dollar has put on a fairly strong rally. We have talked about that in recent months, that we thought the Canadian dollar, at least on a short-term basis, was going to be bottoming. And so we've been right on that. It's pretty hard to be right on currencies. They're always so unpredictable. But nonetheless, our bias at this point in time, with the Canadian dollar up at 84 cents or so, is that it's probably overbought now and a little expensive. And we don't see that as a start to a long-term uptrend in the Canadian dollar. And one of the main reasons that's our belief still at this point is that commodities overall should tend to stay weak for much, much longer. Yes, they can have short-term rebounds, such as oil has had here recently. But around the world, that's the one major problem that keeps coming up, being affirmed, is that economic growth is slow. Disappointing in Japan, continues to be disappointing in China, disappointing in the US. Europe is getting a bit of a run. But nonetheless, seen overall, given some of these changes in emerging markets in China particularly, if commodities will continue on the downtrend or at least stay in a down period, it's unreasonable to think that the Canadian dollar is going to rally very, very strongly. But nonetheless, short term, it's had an impact on our portfolios, as already described. And a corollary to that is that after a long period of time, the Canadian equity market also outperformed international markets, and that's nice to see. And that will have had a positive impact on portfolios. So that's the major vector, I'll say, that I want to review for the last month. As mentioned, lots of things going on. Volatility is building, and we think the volatility overall will probably stay high over the next 3, 4, or 5 months into the fall. Lots of big policy decisions upcoming. The key thing to do in an environment like that is remain very diversified. And, as our portfolios have shown, if you do that, any of the mistakes or errors or attacks of volatility will be best handled, because some other assets will probably do better. That's the benefit of diversification and putting portfolios together with assets that are non-correlated, and that's what we try to do. So concluding here, as always, we like to point out that there's a number of publications available. If you'd like to have more information, more specific information on our strategies and thinking, there's a section on our website entitled Han Thinking, and you'll find a number of articles. The most recent ones you'll be seeing here, particularly refer to a piece that Tyler Morty has written, also been interviewed a number of times, and another article there just posted in the last month that I've written that may be of interest to you as well. Thank you for joining us. We'll see you next month. Goodbye.